Okay, so now that we are on record, I want to take the moment to introduce our presenter. I am thrilled and honored to introduce our presenter, Manisha Thakor, who is the founder and CEO of Money Zen Wealth Management. She's known for making the complex simple. Manisha and her team provides holistic, joy-based financial planning and investment management services for women and families, typically within 1 million to 25 million and up. However, Manisha is also a financial literate advocate, and she very much is all about empowering women. So we are thrilled to have her here. She is also the co-author of 2 personal finance books. So if you don't have them yet, look them up. One is called On My Own 2 Feet, and the other one is called Get Financially Naked. So she has earned her MBA from Harvard and a BA from Wellesley, and she is a certified financial advisor, and certainly you can find her with more information at her website, moneyzen.com. So without further ado, I am going to turn this right over to Manisha. So thank you, Manisha, for coming on.
For joining. I have been working in financial services for over 20 years now, and it's interesting to me, across genders, across ages, across income, the subject that seems to really trip folks up time and again is investing. And so my goal with our talk and our time here today is to leave you with some thoughts that can help you quite literally invest with less stress. And what I have found is that there are a handful of concepts that if you can apply to your life, whether you have $10 a month to invest or you have $10,000 to put away in a retirement plan, that can truly help you simplify your investment life and therefore have a richer life, literally and figuratively. So in terms of what we're going to talk about today, my hope is that you will leave this session with a knowledge of these 5 items. First and foremost, the 3 most important drivers of long-term investment success. If you take nothing away from this talk but point number 1, that alone, I think, will dramatically reduce stress and confusion around investing and make you feel more empowered. Next, we'll talk about your primary investment options and how to select between them. Then we're going to talk about 5 of the most common investment mistakes that I've seen. We'll speak briefly about how to calculate what you'll need in retirement. And I totally encourage everyone on this call to make use of that wonderful resource that Savvy Ladies is offering this month on September 9th. But of course, more typically on the first Monday of the month. This hotline is just incredible to be able to speak with somebody about retirement and just making sure that you're on track or answering other questions. And then just wrapping up with some broader comments about how to honor who you are and who you will become through the act of mindful integrated financial planning, which may not be something that you ever thought about associating with who you are. So without further ado, and then we'll open it up for some questions. So without further ado, I just want to start off with a few words on the current financial landscape. So this is a chart from one of my favorite financial advisors and financial artists, a gentleman by the name of Carl Richards, who believes that any investment concept worth acting upon should be simple enough to draw on the back of a cocktail napkin. And I think that is a marvelous intention. And so here is how I would describe what's going on in financial services and pretty much what's happened over the last 15 years is that we've had a blurring of lines between real investment news and entertainment. With the advent of 24-hour personal finance stations and so forth, there's just an inordinate amount of content that needs to be produced. And oftentimes there's just not that much to say. And so what you end up having is an awful lot of noise that when you listen to it can be absolutely downright terrifying. If you turn on any of the financial press right now, you'll hear lots of talk, of course, understandably about Syria, but also about the September effect and how, oftentimes this is an incredibly volatile period historically, and should you be in the market or out of the market? And it's enough to really scare you. And so there were just three things I wanted to highlight as you're hearing economic news, so that when I walk into the 5 points of the presentation, you can have the comfort and the fortitude to say, that's noise. And that is to say that the US right now is in the worst post-war recovery in history. But the market's done really well. So, since 2008, it's been a really miserable period for a lot of us in terms of jobs, and salary increases have in many cases been negligible, but the market has done really well. And so what does that tell us? That tells us that that even when you have periods of bad economic activity, markets can still move. There's not necessarily a one-for-one correlation. So what we've seen is, and a lot of people are trying to guess what's going on. We've seen that the US dollar has risen in value, even though for the last couple of years, most financial pundits have predicted that it would fall. We've seen that gross national product has been significantly lower than normal. That's sort of kind of an acronym to describe the goods and services we produce domestically. So we're growing slower as a nation, but corporate profits have soared. They're up 70, 80% in the last 5 years. And importantly, stocks have risen even faster than that. They're up about 150% over the last 5 years. So the bottom line is, when you're listening to economic experts and so forth, their arguments always seem to make sense, but statistically speaking, they don't get it right. So don't confuse, number one point, investing with entertainment. And if that's the case, then the logical next question is, well, okay, what the heck should I focus on then when it comes to investing if I'm not supposed to be watching the financial news and making daily decisions off that? And this speaks to what I really think is the most important thing I can share with you, which is the three most important drivers of investment success. And simply put, they're asset allocation, fees, and performance. So one of the first questions I ask anyone, whether it's somebody that I'm working with in my day job where I deal with individuals with 7 and 8 figure portfolios, or whether it's in my other life where I wear a second hat as a financial literacy advocate for women of all income and net worth levels, I always say, do you know these three things about your portfolio? Do you know your asset allocation? Do you know your fees? Do you know your performance over the last year? That's like the financial version of the blood workup when you go to your doctor for an annual physical. And if you know just these three data points, I'm telling you, you will know more than 90% of people about your investments, and it's a great place to start. So let me say a few words about each one of these. Asset allocation is just a fancy schmancy phrase for saying, what is the mix in your portfolio across your broad investment options, which we'll see shortly, essentially are stocks, bonds, cash, and then what people call hard assets, real estate or commodities. And those broad buckets are your basic choices. There are 1,001 sub-flavors within them, but stocks, bonds, cash, and hard assets, again, real estate or commodities, are your basic investment choices. And academic study after academic study shows that 90% of your return over your lifetime will be driven by the percent that you choose to pick in each of those classes across your portfolio. So while you may think your investment success has to be driven by finding the next Apple stock or avoiding the next Facebook IPO and buying it at precisely the right time before it starts to rebound, What really drives return over the long run is A, did you live beneath your means so you're able to save a little bit extra so you could invest to begin with? But then B, did you pick the right mix between stocks, bonds, cash, and hard assets? And in the next slide, I'll talk about how to do that. Hang on one second. I'm getting a note that I've got a little bit of feedback here, so I'm going to turn my volume down a bit and see if that helps. And I'll try and screech a little less. I get excited talking about this. The second point is fees. Every incremental 1% that you pay in fees reduces over a 30-year period the total amount of money that you have by about 20%. So that was a big number, an important number, so I want to say it again. Every additional 1% you pay in fees on your investments over a 30-year period will reduce your return by at least 20%, shrink your nest egg by 20%. So instead of $100, you have $80. So again, instead of worrying about finding which is the next hot investment, if the next thing you focus on is making sure that you're not paying exorbitant fees, right there, you've had a chance to boost things by 20%. So where might the fees come from? There are a couple different layers of fees. Oftentimes when you're investing, let's say at work, through a 401k or a 403b, and you might purchase what's called a mutual fund, and you might think, oh, well, I'm not paying much for this. What you want to check is something that's called the expense ratio. Ideally, I like to see funds with expense ratios of less than 1%. And if you're confused, you can ask your benefits or your HR director to help show you legally in these plans they have to disclose fees. So that's one of the most common places. If you're working with an advisor, of course I am one, so I think there's value in doing that. But you want to make sure that the fee that you're paying an advisor plus the fees that you are paying for any investments all in are not much more than 1.5%. Anything above that for the blend of the advice and the products that you're getting in really starts to eat into your long run returns. So asset allocation, fees, and then the last piece is just to pay attention to performance, and not daily, not monthly, honestly, not even quarterly. Once a year, make sure that you stop and look. End of the year is a perfect period. You can look at it on calendar year bases and see what your performance was. And the purpose for doing that is just to stay informed. If you have a game plan that assumes average returns of 7% a year, and over a 5-year period you're finding that you're nowhere near there, that tells you may have to adjust your spending or your work expectations accordingly, spending a little less or maybe planning to work a little more, especially as you get closer to retirement years. I'm going on and on about these 3 points because I would say less than 2% of people that I ask this of, and I'm including in this group girlfriends of mine from my corporate life in financial services, don't know their asset allocation, their fees, and their performance. So while it may sound like this is really simple advice, the vast majority of people don't know it, and you will be so empowered once you do. So that's what to start off focusing on. Let me now say a few words about why to invest as I move into what your investment options are. A lot of times people will say, the market is so unpredictable. I hear what you're saying, Manisha, about this confusion between news and entertainment, about how economic forecasters can make these arguments that sound really crisp but don't necessarily pan out. Why should I bother with this investing stuff at all? And the reason is inflation. Inflation is like termites eating away at the foundation of your personal finances. If we assume inflation is 3%, which has been the historical rate at which prices have risen, $1,000 today in 30 years will only buy as much as $400 does today. and that's at 3%. I'll inch that up a little bit to 5%, and $1,000 today loses nearly 4/5 of its value. And so the way I like to think about inflation, it's like if you came home from work one day and you had $1,000 in your back pocket and you're like, you know what, take this job and shove it. I am sitting on my tush and I'm going to watch the reruns of Scandal, Breaking Bad, and Dexter over and over for the next 30 years and not move. What would happen when you stood up? Well, you'd still have $1,000 in your back pocket, but you'd fall over because you hadn't moved for 30 years. Your muscles would have atrophied. And the same thing happens to your money if it's not being invested. It's atrophying as well. And that's why it will be worth less in the future. So the reason you invest is to combat inflation. And if you do a good job, hopefully you will grow your money not only fast enough to keep up with inflation, but to actually increase your purchasing power. So this reverse chart, I used a nice big juicy round number, which may be a little unrealistic, but it makes a really nice point, which is to say, you know what? If you had $1,000 and it grew at 10%, you know, how much would that become in 10 years, 20 years, 30 years, 50 years? And you can see that the power of investing is enormous. So that's the reason why you step into this universe of investing. But what are your choices? So this data here shows you the long run returns from 1926, which is when we have the first really good historical data on securities, up through the most recent calendar year end. And over that time period, and including some really cruddy years like 2008 and 2009, stocks have generated an average return of 9.8%. Bonds, long-term bonds, a little lower at 5.7%. T-bills, treasury bills, which are much shorter term, fixed income instruments have been 3.5%, and inflation's averaged 3%. So these are your basic options. And as you can see, the one that has done the best is stocks. The problem is, how do you know which stocks to buy? I already suggested that you might not want to spend your time trying to identify individual specific, really micro trends or securities. Why is that? And the answer is on this next page here. It's like looking for a four-leaf clover. This is a really busy chart. The simple way to think about this is just to look at the colors. The colors represent different styles of stocks. Large companies, really tiny companies, international companies, real estate companies. And what you can see is, you know, go take a look at 1993 and 1994. What do you see? Well, right at the top of the chart there, you see some numbers in purple that look pretty darn good. I'd like to get nearly 47% and 16% on my returns. But if you jumped into that in 93, 94, look what happens in 95, 96, 97. Those purple numbers drop to the bottom of the heap in terms of what's performing well. And then bounce back up. Take a look at, you know, what happened in 1998. Something looks pretty good. The S&P, almost 29% return in 98. So you might think, well, that's where I'm going. But then follow the trajectory there. That particular investment was middle of the pack in 99, and from 2000 to 2002 was at the bottom of the pack. And so the point is, it's incredibly hard to know. We know broad trends, but it's incredibly hard to identify which individual stock or which specific style of investments is going to win in any particular year. So what are you supposed to do with all of that information? What the suggestion that I have is to broadly think about how much you want to put in stocks, bonds, and cash using this formula that was made popular by John Bogle. It's 100 minus your age. 100 minus your age is a good rough rule of thumb for the amount of your portfolio to be in stocks. So I'm 43. let's round that up to 45 and say, 100 minus 45. And you can get a sense there of, how much I should have in stocks, right? So that would give me 55% in stocks, 45% in bonds at my age. Another way you can think about how much to put in stocks is to think about it in this framework of your ability, your willingness, and your need to take risk. Your ability to take risk relates to when you're going to need to spend that money. If you need to spend money in the next 5 years, you don't want to put more than 20% of it into stocks because of this previous chart that we saw. You just never know what's going to be doing well in any particular year. When you have a very long time horizon, then you know that you can keep your money in stocks for a longer period. So as you're thinking about how much to put in stocks, you can start with a 100 minus your age as a rough rule of thumb, and then you can finesse it by taking your money and putting in buckets. Like if there's money that you know you need to spend in the next 1 to 3 years, let's say for debt pay down or down payment on a home or college tuition, you don't want to put any of that in stocks. Another way to think about how much to put in stocks is to ask yourself how much you're willing to lose, how much volatility can you stomach before you might feel like you need to change course. And of course, what you can see in this middle column, willingness to take risk, is the more volatility you're willing to stomach, the more equity exposure you can have. And then the final column speaks to this issue of retirement spending, which we'll come to slightly later. But one way you can think about how much risk you need to take is what kind of return do you need to get in order to achieve your financial goals. And of course, the higher return that you need, the more you would need to put into equities. And so the way I use this chart with clients is I do both. We first do the very simplistic 100 minus your age, and we say, okay, that's one way to look at what your mix should be between stocks and bonds. And then we go and we look on each one of these 3 metrics, your ability to take risk, your willingness to take risk, your need to take risk, and we come up with a number. And sometimes it's wildly different. Like somebody may say, well, I have a 20-year time horizon, so in theory, I can have 100% in stocks. But honestly, Manisha, if my portfolio goes down more than 10%, I'm going to hurl. So on that second metric, it tells us the maximum exposure is 30%. And then we take a look at what kind of returns they need to reach their retirement goals, and we find out it's about 7%. So that's, right in between the 40 to 60% mark. So that tells us a 50% allocation. And then we might average all 3 numbers together to come up. So my point is there's not a precise formula, but there are these ways of thinking that can help, these rough rules of thumb about your ability, your willingness, and your need to take risk that can help drive how much you decide to put into stocks. And the point that I want to emphasize is thinking about your portfolio this way, for the vast majority of people, unless you want to be a professional investor, is a much better use of your time than studying the financial pages and trying to pick the next hot stock. Another concept, so if I said the first thing I want you to remember from this talk is the 3 things to know about your portfolio, like the blood workup at your annual physical, are asset allocation, fees, and performance. If you know those 3 facts, you will know more than 90% of people about your personal investment portfolio. The second thing I want you to know is about the pain of mistiming the market. This chart shows from 1970 through, year end last year, so 42 years. And that's approximately 10,750 trading days. And if you had stayed in the market for the entire period, and I apologize, as I'm looking at this chart, I realized in making the numbers bigger, I shifted the legend over a little too far, but that black bar corresponds to the total period. So if you had kept your money in the market through the good times, through the bad times, and in the last 42 years, we've had a lot of both, you would have had a total return of 9.94%. Your $1,000 would have grown to over $58,000. But if you had missed simply the best 25 days out of those 10,750 days, instead of $58,000, you'd have just about $14,000. So the point that I want to really, really hammer home is there are huge swings in the market, and they're only going to get bigger because information is moving around with such rapidity. And so one of the best defenses and offenses for your portfolio is not to try and fight that, but to create an asset allocation that enables you to weather the thick and the thin so that you can stay put, so that when those really great days come, you're there. So how do you do that? I'm a big believer in the cash buffer. So what I tell clients to do is to keep enough in cash that they can breathe, so that whatever they're putting in their investment portfolio truly is long-term money that they can create a plan around and let it sit and ride out the inevitable ups and downs. And so for some people, that may be a 3-month cash cushion. I know some people who need a whole year in cash. Other people are in between, where they just need to know that the things that they have to spend money on in the next year are in cash. And then that enables them to take the rest and spread it across stocks and bonds for the long term. One last chart on this point that I want to highlight, especially because with all the news going on right now with some of the foreign crises that our globe is dealing with, and the fact that statistically the fall has historically been a very volatile period, is to show you this chart. The orange dots represent any single quarter, any 3-month period in a calendar year, and it represents the worst quarter in that year. And then the gray bars represent the total return for that year. So if you go back to 1987, what you can see is that there was one quarter, and that was the crash in 87, where the market was down in that quarter 25%. But if you had stayed throughout the entire year, look at the gray bar, it's still positive. Now, that's not always the case. I mean, if you look at 2008, 2000, 2001, 2002, we had some down quarters and there were down years. But in the vast majority of years, what you'll see is there's some real stinkers of quarters. But if you can stay disciplined, because you have the cash buffer for your near-term needs, because you thought strategically about your asset allocation, because you know your fees are reasonable, you stay put through the thick and thin, you experience the return in the gray bars over the long run. So this notion of kind of riding the wave, if you will, is the second really, really big takeaway. Before I go into common mistakes, I just want to say a couple words about what to invest in, because I've been speaking in broad generalities. Personally, I'm a really big fan of index funds and ETFs, both of which I like to think about as financial smoothies, where you get bits and pieces of lots of different types of companies, some US, some international, some big companies, some medium companies, some small companies, some growth companies, some value companies. And many employers now are offering what are called target date retirement funds, many of which are now built from underlying index funds. And these vehicles are increasingly very effective ways to invest, because what they enable you to do is have an asset allocation that's appropriate to your age. And they have these really, funky sounding names like Target Date 2020 or Target Date 2045. And those years simply correspond to the year in which you think you'll retire. And the way they work is the fund companies will shift the all-important asset allocation between stocks, bonds, and cash to be more aggressive when you're younger and less aggressive as you're older. And so long as the fees on those funds are reasonable, I've found them to be a very effective way for people to invest with less stress. Another firm that I really, really like if you're starting out and you want a little bit more guidance on creating a portfolio that may be outside of your workplace. Maybe you've got an IRA that you've opened up on your own. You've got $5, $10, $15,000 in there. You're just not sure what to do with it, or you're saving in a taxable account, is a firm called Betterment, BETTERMENT.com. They provide low-cost, high-quality investment management services for portfolios at a range of dollar amounts. You don't have to have $1 million to go to Betterment, and they use a strategy very similar to what we're talking about here. I think they're an extremely well-run company. So on to common investment mistakes. We've talked about the first two, being overly influenced about what you've just heard in the news, not knowing the three most important things in your portfolio, your asset allocation, your fees, and last year's performance. A third one is not having a written plan. Corporations, endowments, foundations, they all have something called investment policy statements, which basically just say, this is the game plan I set for my portfolio. This is the logic as to why I did it. And I am agreeing to review this every 6 months to 1 year to make sure nothing in my life has changed that would make me want to change that plan. And so I strongly suggest creating your own investment policy statement. It doesn't have to be anything fancy. It can be a simple one-page written document, but there's something about putting it in writing that is tremendously powerful when the markets hit those inevitable bumpy chats. The fourth common investment mistake I've referred to several times, in the abstract, and now I want to hit on it a little more specifically. Oh no, we're having a little more sound feedback. Guys, I'm so sorry about this. I'm going to try and talk a little softer and see if maybe my screeching is causing this. The cash buffer idea here, again, is making sure that you do not invest money that you know you need to spend in the next 5 years. That gives you the flexibility to ride the ups and the downs. So, and I just keep beating this over and over again, because one of the most common things I hear once somebody's able to save $2,000, $3,000, $4,000 is, how do I invest this? And I think the first question should be, do I have anything do I have a need for any additional cash? Sorry, 1 second, guys. We're having a little technical difficulty. 1 second. So that's the second one, the cash buffer. And then the final point of confusion is confusing complexity with effectiveness. And I see this a lot, where there's this feeling like, well, investing is complicated. And if it weren't, why would there be all these financial firms with all of these super smart people using these phrases that I can't even understand? And I include myself in that group. And I've worked in the industry, as I mentioned, for over 20 years. And I went to Harvard Business School, and daily I come across financial terms that I have no idea what they mean, and I have to look them up. There is this, I think, underlying misconception that investing needs to be complex. But as Warren Buffett and many other successful long-term investors have shown, that's just not the case. You can generate incredibly solid returns using a very straightforward a very straightforward investment approach. And let me just explain that briefly. There are two ways to invest. One is an active strategy and one is a passive strategy. In an active strategy, what you're trying to do is time the market by trading in and out of specific sectors or individual securities. And your goal is to try and beat the market. This kind of strategy tends to have a higher fee associated with it for the potential of possibly outsized returns. But as we learned earlier, even just an incremental 1% higher fee can eat up 20% of your returns over the long run. So that's a pretty big deal. Versus another approach, and about 85% of market participants are active, versus this other approach, which is called passive. And in this strategy, it's creating portfolios where you basically buy broad buckets of stocks. So you'll decide you want some in international, and you'll buy an international index fund or ETF, and you'll own literally hundreds of international companies in the developed or the developing markets. And the idea here is not to try to beat the market, it is to quite literally be the market, to capture the return of that underlying style of investment and not try and look for that clover, that four-leaf clover. And what's fascinating about it is that if you look at history, most of the great investors would argue, including Peter Lynch, who used to run an active fund. He says, all the time and effort that people devote to picking the right fund, the hot hand, the great manager have in most cases led to no advantage. And Warren Buffett says, most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. So the reason you may not have heard this message before is that it's not as lucrative for fund companies, but certainly for us end investors, it's a very powerful strategy. And so just to kind of wrap and head into questions, a key concept that I want you to leave with is this chart again from Carl Richards, showing the correlation between simplicity and effectiveness. This is true in so many areas of our life, but honestly, there is not one that I think is a clearer example of this correlation than the world of investing. If you pick the right mix of stocks, bonds, and cash, within each of them, you use low-cost index or passive-oriented type funds to capture those classes. You keep your fees low and you keep an eye on performance. And if you run through a couple of bad years, you know you need to maybe ratchet your spending down a little bit or add an extra year or so towards your game plan for retiring. But the entire process can literally be that straightforward. And if you want to read a few more books on this topic, a couple that I really love are, one is called Investing Made Simple by a gentleman named Michael Piper. This book is literally less than 100 pages. You can read it in 2 to 3 hours. Investing Made Simple, tiny, tiny paperback. And it does one of the clearest jobs I have ever seen of explaining in more detail what we've discussed here today. Another book that I really like and I highly recommend is called A Random Walk Guide to Investing by Burton Malkiel. Now you may recall, if you took any economics in school, a book called A Random Walk Guide to Wall Street by Professor Burton Malkiel from Princeton. It's a big, thick textbook. This is different. It's a thin paperback book that he wrote for real people, A Random Walk Guide to Investing, and it talks about the key rules of investing. Again, many similarities to what you will have heard here today. He goes into more detail. And the last book, if you're on the margin, I talked to you about this concept of passive investing. I like to call it evidence-based investing because the statistics show it works so well. But you're still feeling skeptical, like, how can that work? I'm pretty sure I can, if I just work hard enough, I can find a few good investments that are going to beat the market. A good book to read if you're on the fence on whether you want to be an active or passive investor is called The Investment Answer. So it's The Investment Answer by Dan Goldie and Gordon Murray. And again, all the books that I'm recommending are less than 150 pages. So they're quick, powerful, powerful reads. And the last thing I'll say before opening up to questions is really just that I have found in talking to women of all ages, geographical career, life stage. You can parse it any way you want. And I notice over and over again that the vast majority of people don't tend to think about their financial well-being as one of the components that they focus on nurturing regularly. My hunch is because you're on this call and you've already discovered the wonderful world of savvy ladies that you guys are not in that group. You are part of the few that do know how important it is to tend to your financial health and financial well-being. But I wanted to leave you with this last chart, which again from Carl Richards, shows the intersection between your goals and your dreams and then your financial resources. And to me, the whole purpose of financial planning and of investing is to identify for yourself that point of intersection. That's your best financial life. It looks different for every single person. Um, but that framework to me really helps put investing into perspective and explain why it is that we're doing it. We're not doing it to try and beat the market. We're doing it to make sure that we have the greatest odds of our goals and our dreams coming through. So with that, let me stop yammering and see if we have any questions. And I also want to mention, I think we may be putting up a link to a video. I was so moved watching the introductory video to this call and hearing the words shame and embarrassment, because I hear this over and over again around personal finance. And so if you're feeling any of those emotions about investing, we've got a short little video. It's part of the Dove series, actually. When I first saw it, it made me cry. It's really poignant. And I use it and share it with people just as a reminder that you'd be amazed if you got inside everyone's heads what they're thinking and versus what you're thinking. And so just dive right in when it comes to investing or asking questions. This is one of the areas that I feel like we just don't have enough open and honest dialogue. And so if you've got a question, I can pretty much promise you about 10 other people around you have the same one. So with that, Regina, let me stop talking there and see if there are any questions I might be able to answer.
Sure. First of all, thank you very much with all of your information. It's very helpful. There are a couple, but before we get started, I wanted to just say that we just posted the link that you were talking about for the Dove
I'm wondering if we're
Beauties.
having some technical difficulties.
Can you hear me? So we just posted the link that you referenced in regards to the YouTube. Hang on for 1 sec. I can't, Manisha?
Okay, it looks like we may not have any questions. So if that's the case, I'm going to turn it back over to Regina to wrap.
Actually, Manisha, there were one or two questions. So I'm gonna, if you can hear me, I'm gonna basically ask. There was a question that if you could just, for those savvy ladies that are still learning, could you just define ETFs for us? Manisha? All right, I apologize for the Manisha, are you on mute?
No, now I can hear you.
Okay, so the question was someone asked if you could define ETFs.
Absolutely. And sorry, guys, I had my volume turned down.
Okay.
So ETF stands for Exchange Traded Fund. It's very, very similar to an index fund. It's a basket of stocks or bonds that are selected based on predefined criteria. When they first came out, they were very broad criteria like big stocks, small stocks. Now they've, as with most things in the investing world, developed a bajillion different flavors. So you can get small energy stocks, that are from companies west of the Mississippi. I mean, you can get some really specific ones, but the key point is it's a static basket. Typically doesn't cost a lot to purchase. And the main difference between an ETF and an index fund is an ETF trades all day long. And so I have a slight conceptual issue with it, which is that if the benefit of an ETF is to trade all day long, but the point of owning a broad basket is to be disciplined and to stay put, why do we need the temptation of being able to trade all day long? So I can't say I'm the world's biggest fan of ETFs. I still prefer index funds in most cases over them. The one exception is that with an ETF, you can put in a limit order or which would enable you to say something like, I want to sell this ETF when it hits this price, or I want to buy it anytime it drops below XYZ price. And because ETFs trade intraday, you can do that. Index funds price only at the end of the day at what's called net asset value. So you don't have that flexibility. But again, my mantra is keep it simple. If you're not trading in and out during the day, oftentimes an index fund can be a better choice.
Great. Thank you. Another thing that came up was when you were talking in regards to the cash with all the swings that are taking place and wanting to properly allocate and taking the cash funds. Is there a rule of thumb? I realize that it could be different for different people based on where they are with their overall funds, but is there a rule of thumb based on someone's income in terms of what percentage would make sense to allocate from a cash point as opposed to other things?
That's an interesting way to think about it. I have tended to think about it relative to monthly expenses versus income.
Okay.
And that's where you get these rough rules of thumb. Like if you know your monthly expenses are $2,000 a month, I like to see people have at least $6,000 in as a cash buffer, 3 months of living expenses. Um, and so, and the reason I like to link it to expenses versus income is the expenses are what are going to bite you in the tushy if something happens to your income and you need to still make sure that you can meet those expenses. In an ideal world, you'd like to see the buffer be even longer, but when you're in your 20s and 30s, it's almost mathematically impossible unless you have a super high salary to get there. So I like to tell people by the time you're in your 40s, what I'd like to see you have a 6, 9, 12-month emergency fund. Absolutely. If you're listening in your 20s and 30s, just start by aiming for that 3-month fund.
Great. That's very helpful. I think there was one other question I believe Kristen had. It was in regards to your slide that you were talking, referencing equities. Was that, did that mean stocks, bonds, etc. in terms of that? And I believe that slide was sort of the middle of the presentation.
Yeah, let me just go back and make sure that I'm on the right one. Kristen, if you were thinking about this slide, the 9.8 is stocks, 5.7 is bonds, long-term bonds, 3.5 is short-term bonds. If you were referring to this chart, this was just stocks and real estate. It did not have bonds on it. If we'd added bonds, you would have seen the exact same trend as well. And I'm just trying to.
Kristen, I just opened you up. If you can answer that. I guess not. Okay.
You may be having the same problem Kristen I am. I didn't have my volume up, so I'm talking away. No, but I couldn't hear anyone. You can also type in chat if you see that, Kristen, if we're not hitting the right slide. I'll just say if you were asking about this slide is also pure equities. But again, it would look similar if we included bonds.
Great. I think there were one other question, I think, and you brought it up because I think you were talking about expense ratios, and I think that was a well point in regards to your advisors. And I think that as we're starting, some people are at different levels, and it would be really helpful for those that are just starting with investments. Like what are like one or two takeaways before they actually go to an advisor that you would recommend?
So I think the first thing I would say is make sure you're maxing out your employer plans first, because your employer has a fiduciary obligation to select options in the retirement plans that are reasonably priced and have a good mix. So by starting to save through a 403b or 401k or 457 plan before you even venture out to an investor, you're generally speaking swimming in a relatively safe pool because the first level of vetting was already done for you by your firm. The second thing that I would say when talking to someone is making sure that they understand any cash needs you absolutely have to have. And the reason I keep harping on this is we as advisors often get paid as a percent of assets under management. So we have an incentive to want as much of your money as possible. But you have an incentive to make sure that you can continue your life no matter what happens. And so you just want to make sure your advisor is talking to you about that cash buffer. And then the third thing that I would say is if you can read just one of those three books we recommended, Investing Made Simple, A Random Walk Guide to Investing, or The Investment Answer before talking to someone, you will feel so much more informed going in there. And I promise you, it will not take longer than 2 or 3 hours to read any of those books, and they're written in very straightforward language.
Perfect.